What if a company built on AI, behavioral economics, and a commitment to social good could disrupt a multi-trillion-dollar industry? That's the promise of Lemonade Insurance. But is it worth investing in? Welcome to How to Invest. In today's video, we're going to answer that exact question. First off, what does Lemonade Insurance actually sell? Well, they sell many different types of insurance: homeowners, renters, pet, and now car insurance, as well as a few different types of liability and term life insurance. So what makes Lemonade so special? They do the same thing so many other insurance companies do, right? Well, here is the major business model shakeup. The typical insurance business model pits the insurer against the customer. For every dollar the insurer doesn't pay to the customer when the customer makes a claim, that goes to profit for the insurance company, which makes a relationship where they are fighting against each other. The insurance company is not trying to pay out, and the customer is trying to get the maximum amount out of the insurance company. Lemonade disrupts this business model by adding in a third-party beneficiary. In this model, it aligns the incentives of the customer and the insurance company. The insurance company, Lemonade in this case, takes their cut for operations, and any unpaid insurance claims by the customer gets paid out to the customer's charity of choice. This business model aligns incentives. The insurance company doesn't make additional profit when they decline the claim of the customer. And when the customer doesn't make claims that are not warranted, the excess goes to the charity of their choice. So you can see how this actually makes a very cooperative business model instead. This business model shakeup alone can already disrupt, in my opinion, the entire insurance industry. Just by making sure that the incentives are aligned provides a much better customer experience for the customer. When customers have better experiences, they tell their friends, and you get this flywheel of growth that other insurance companies just cannot compete with. This is how Daniel Schreiber, co-founder and CEO, puts it himself.
One of the unique things about Lemonade is what I would call business model alignment. I'll put it in my own words, which is legacy insurance companies make money when they make you more miserable. You're in your time of need. You had a flood, God forbid, fire, car accident, and they try everything possible to deny your claim because they make their profit over the leftovers. You chose from the outset, one of the things that attracted me, call it flat fee, more sassy business model, where you don't make any more money because the claims are denied. And then you said, whatever's left, we'll give to the charity of the consumer's choice. So congratulations, if you want to be a fraudulent consumer of this insurance company, you will have stolen money from the American Cancer Society or something like that. And that aligns behavior. Is that a fair description of your business model choice?
Sure.
Okay. Other companies get involved in, let's call it charitable or not-for-profit endeavors as well. They have something called CSR, corporate social responsibility. Can you help me understand the difference between Lemonade's business model and the business model, for argument's sake, of Geico or State Farm and their corporate social responsibility arm?
Yeah, I think at a foundational level, what we're trying to achieve is enlightened self-interest. In other words, we're trying to solve a business problem through charitable giving. We've never apologized to our investors or excused the donations that we've made. We're a young company. We've donated over $6 million to charity. And the reason we never feel the need to excuse it is because we think it's actually accretive to shareholder value. Now, that's counterintuitive, but insurance is plagued by dishonesty and fraud. And it's an unusual kind of fraud. A lot of online businesses are plagued by fraud, and typically it's some hackers from some foreign country who steal your credit cards, and that's what we associate with the name fraud. Phishing campaigns, stuff like that. In insurance, it's different. In insurance, the people who are defrauding the insurance company are people like you and me, people who self-conceive as upstanding citizens. And if you chart their behavior, it's generally good, until they make an insurance claim, and then they let the devil out, and then they go back to being good. And that is a fascinating phenomena. And in the very early days of Lemonade, we sought out experts in game theory and in behavioral economics. And I hounded Professor Kahneman until he agreed to chat to me. And Dan Ariely joined our founding team. And It was really to try and understand that exact question. What is it about insurance that brings out the devil in us? And at a mathematical level, insurance is about a community of people pooling their resources to help their weakest member in their hour of need. That is almost the definition of a charity. That's the International Red Cross kind of thing, right? And yet the perception of insurance couldn't be more removed from that if you tried. And Shai and I were just, as newcomers to the space, fascinated by that. And Dan had recently completed a book called The Honest Truth About Dishonesty. And after 10 years of researching this, he kind of concluded that if you set out to create a system to bring out the worst in humanity, it would look a lot like a modern insurance company. Everything that you ought not to do if you want honest behavior is manifested in insurance companies. The win-lose proposition that you just, zero-sum game that you just described, asymmetry of information, you have no idea what your policy says, I know what it says, asymmetry of power, you've already given me the money, now you want to take it back. All these things make us feel entitled to embellish and lie because we feel like the playing field isn't even. And if the playing field isn't even, I've got to start high to get to where I deserve to get to. And it's kind of that we took a run at. We wanted to see if there was a way to change the game using game theory nomenclature and change it from being a two-person conflicted game to a three-person game. And the charity is really that third person that changes the very nature of the game. So for us, signaling that, hey, we're going to cap our profits. We're going to cap them at 25% gross margin. We're not going to exceed that. And if there's ever an opportunity to take more than that, we won't. We're going to tie our hands and that money will go to a charity. That's an important signal for us. It changes our incentives. It puts that money that poisons the well beyond our reach. But it also invites you to change your mindset, to think about the nature of the interaction differently. And rather than thinking about it as a conflicted relationship where you have to defend yourself, you are suddenly thinking, hey, one second, that charity that I chose, it's that will suffer the consequences of my actions. And a victimless crime is suddenly no longer a victimless crime. So for all of those reasons, when we give charity, we feel like we're adding shareholder value. We're resolving a business challenge, which is the deep fraud and dishonesty that plagues the industry. There are concentric circles beyond that. There's low loyalty, low brand affinity, high cost of acquisition, and all of these, to some extent, tie back to that same fundamental problem of distrust.
This business model, which has nothing to do with technology, is already an order of magnitude improvement in the insurance industry. Now, on top of this business model improvement, there is also a massive data and efficiency improvement that Lemonade brings to the table. This data and efficiency improvement brings yet another order of magnitude improvement to the insurance industry. Lemonade is a digital native company. Unlike the legacy insurance companies, traditional insurance companies have both tech and cultural debt. Now let me explain. Tech debt just basically means you take on all of these legacy systems that don't really communicate, and then it becomes very entrenched in your company, and it's very hard to remove those old legacy systems to bring in new systems. So they're stuck in a bunch of legacy systems that don't communicate to each other, don't work well, and ultimately is a type of debt. On top of the tech debt, they also have a cultural debt. Basically, they have these really antiquated business models where they work with a bunch of different, basically people who sell the insurance for them. They consistently pay them a fee over time. You have these just really old companies that aren't super focused on efficiency anymore. They're not founder-led. You have a CEO who's there just to increase shareholder profit as much as possible, and not worried about innovation. So you create this culture of basically complacency, where if it runs okay, it is okay. There's no type of trying to optimize systems, and you just do not have that in a brand new company. Well, not brand new, it's about 10 years old, in a newer company like Lemonade. Lemonade being a digital native company means they do not have any of those debts. They are a tech company culture, which means they are super, super forward on innovation and efficiency and automation, which is never a better time to be all about automation in this new age of AI. And they have built their own digital system from the ground up, and it is literally just one piece of software. Everything goes through this one system instead of a bunch of different siloed systems that can't communicate to each other. It just means everything runs way more smoothly, everything can communicate to each other. It's just incredible. They can also push out changes to their policies much quicker. To best demonstrate this difference between how legacy insurance companies operate and how Lemonade operates, I would love this clip from Daniel Schreiber, again, the CEO of Lemonade, telling a beautiful story that really illustrates the difference.
One story that I've told and that kind of stuck with me is we launched Lemonade in September 2016. That was our first sales. We were in New York City. We just launched, and John Peters, who had just that week signed on to become our chief underwriting officer. He was the chief underwriting officer at Liberty Mutual, and he joined us. He still is. All these years later, it was his first 2 or 3 days on the job, and he was looking at the sales. We had this huge digital map in the room on a TV screen, and as people were making sales, you could start seeing dots appear on the map as people bought policies from us. And he started seeing a concentration of risks around, I don't know, New Jersey or somewhere. I forget. I think it was some coastal region that he felt uncomfortable with. He says to me, Daniel, I don't like the way we're doing that. I'd like to change something. I said, sure. There was one of our head engineers, his name was Moshe, and I said, hey, why don't you tell Moshe what the changes that you want? And he says to Moshe, listen, what I'd really like is that no more than 5% of our premiums or 5% of our policies, I forget which one it was, shouldn't be within whatever it was, 5 miles of the coast. I forget exactly what his guidance was. And Moshe's writing it down. And John says, is that okay? And he says, yeah, I've implemented it. He says, what do you mean you've implemented it? So, well, I just made the change and I pushed it into production. And that blew John's mind. He said, he comes, and Moshe was a little startled. He says, sorry, do you want me to undo that? And John says, no, that's great. And he comes to me and says, listen, I wanted to know, at my prior employer, it would have taken us 9, 10, 12 months to recognize that we have an issue that needs resolving. The concentration issue that I just discussed. And then it would enter the budget discussions for the next year about whether or not this is a change that warrants going to the IT firm that we use and including it in the RFP that we submit to them to make these kinds of changes. And being able to do that kind of thing at that kind of pace, those kinds of changes, we've understood increasingly over time, doesn't simply mean that you solve things faster. It really changes the whole nature of how you underwrite risks and the pace, the risks you're willing to take, because if you can catch them quickly and correct for them in a short cycle, you just conduct your business in a different way.
So you have 2 order of magnitudes improvements for Lemonade. You have the order of magnitude improvement in the business model, and then an order of magnitude improvement in the data, the efficiency, the digital native, the automation, all of those type of tech bits. So it's just an incredible business model, very disruptive to a very, very, 100-year-old industry. So now that we've talked about how they're really disruptive, let's talk about some of their moats. So there are really 5 types of moats. There are network effects, switching costs, low cost production, intangible assets, and then there is counter positioning, which is like a disruptive business model. So let's see how these moats apply to Lemonade. So first off, network effect. Does Lemonade have a network effect? Yes, it absolutely does. The more people that Lemonade insures, the more data that Lemonade gets, which creates a better experience for the next customer. So the more customers that are on Lemonade, the better Lemonade can price and the better customer experience Lemonade can give to its customers. So it absolutely has a network effect. Next, switching costs. Switching costs, I believe that it also has this moat as well. It's very painful to switch insurance. It takes a lot of time. You have to shop. You have to look at different options. It's much, much easier just to say, I already have car insurance with this company. Oh, they also offer home insurance. Super easy, all in one place, and that's what Lemonade offers. Another switching cost that Lemonade has is their platform is so easy to use. It's very intuitive, and so if you switch insurance, you have to learn the other insurance legacy insurers platform, which is usually much more difficult. Lemonade also has the moat of lowest cost of production because they automate so much and they don't have actual agents that they have to pay out a percentage of the premium for the entire lifetime of the customer. They are also able to offer the lowest cost insurance. Because they use a lot of bots for customer service and for claims, they literally have the lowest cost production for insurance as well. In terms of intangible assets, they also have a moat there. Because insurance is very, very regulated, you have to get licenses in every single jurisdiction you service. So it's a kind of government regulated kind of moat. It's very hard to get into this industry to get the proper licenses. It took Lemonade months originally to get their license in New York. So yet this is yet another moat that Lemonade has. And lastly, as we talked about before, they have a very, very disruptive business model. So that this is another moat on top of. So out of all 5 moats I mentioned, Lemonade literally has every single one. So they are disrupting the industry. They are absolutely growing like crazy, and they have so many moats. They are a very, very safe business, and they are just chugging away. Just before I go over potential returns, just a quick disclaimer, this is not financial advice, this is just for education and entertainment. With all that in mind, let's talk about some growth and potential returns. Based on our modeling, Lemonade could be a 4x in 5 years, it could be an 18x in 10 years, and a 75x in 20 years. This represents incredible potential returns. And these potential returns are based on our base case. If you're interested in learning more about our bull case and bear case, you can watch this live stream that I did here. Thank you very much for watching, and I hope you enjoyed. Have a great day.